There were people who were real gold bugs as a consequence of the $35 to $200 move that occurred prior to 1975. And those people forgot how to spell gold in the next 9 months. They got shaken out of that market. And they got shaken out of a market that then rose eightfold in 5.5 years. So I believe that this gold bull market that we're into is one for the record books. I also believe that people who aren't financially and psychologically durable are going to get shaken out of it. So forewarned is forearmed. I'm not going to get shaken out of it. Well, first of all, I'm delighted to hear you say nominal highs, because in constant dollar highs, the gold and silver prices that we see arguably are not all-time highs. Dunnigan, as you know, I've been saving in gold since the year 2000. Turn of the century, turn of the millennium for that matter, I decided to change a few things that I did. And although I maintain liquidity in US dollars, I save in gold. And if you save in gold, you're surprised at how cheap things are now. You're surprised at how cheap housing is. You're surprised at how cheap groceries are. You're surprised at how cheap gasoline and medical insurance are. If you save in dollars, you have a very different perspective. And I would suggest that the increase that you've seen recently in gold and silver prices goes back to interviews that you and I had 4 or 5 years ago, the difference between inevitable and imminent. What was going to happen to the gold price is now happening. I don't think that the gold price that we see now takes into account the damage that will be done in the future. I think we're playing catch up. And let me give you some arithmetic around that. My own belief is that the principal reason that precious metals do well is because savers and investors are concerned about the deterioration of their purchasing power in fiat-denominated instruments, US dollar-denominated instruments. And they are particularly concerned about the difference between the interest rate they get paid on savings products and the deterioration of the purchasing power of the dollar. And that's where the gold price and the gold price in the future really comes to bear. It is my belief, and we've discussed this before, Dunnigan, that the real rate of the deterioration of the purchasing power of the US dollar is not measured by the CPI, which is bad enough, but rather is closer to 8 or 9% compounded. If you look at the basket of goods and services that you and I buy, as opposed to the basket of goods and services contrived by the Bureau of Labor Statistics, what you see is that the rate of inflation that people are fed is really, really, really understated. And here's where the problem comes into focus for most folks. You take out a savings product, let's say the world's preeminent savings product, the U.S. 10-year Treasury, which all other credit products are marked against. You're getting paid 4.2. 4.2 isn't bad, unless you consider that you're getting paid 4.2 in a currency where your purchasing power is decreasing by 8. Then rather than making 4.2, you're losing 3.8. And if you lose 3.8 every year for 10 years, what the U.S. government is saying is if you give us your money now, we'll give you back 60% of it 10 years from now, which is not a very attractive proposition. But it is the proposition that's driving gold.
The real driver behind rising precious metal prices isn't fear, it's arithmetic. Savers face a widening gap between interest earned and purchasing power lost. Official inflation figures suggest moderate erosion, but lived experience tells a different story. For most households, true inflation feels closer to high single digits. When savings accounts or government bonds yield less than this real loss, wealth declines year after year. Over a decade, that erosion compounds dramatically. In effect, long-term savers are subsidizing borrowers and governments. Gold benefits because it sits outside this system, offering protection when traditional savings quietly fail.
Disintermediation out of long-term savings products like long-term bonds into gold is self-defense. It's really as simple as that. And I think it continues. And I'm going to bore your audience with more math. Dunnigan, I can see you ready to hit me with that already broken hand, but I'm going to do it anyway. And we've talked about this before, but it needs to be hammered home to people because they hate math. That circumstance gets worse, Dunnigan. In the first instance, there's a lot of pressure politically, which will come to bear today, on the Fed to lower interest rates. which means that nominal prices should increase while the price paid for savings decreases. In other words, the gap is going to get wider as a consequence of lower interest rates. And make no mistake, lower interest rates are politically popular. They're a subsidy to spenders by savers. Spenders being more numerous than savers, we could expect that to continue in a politicized society like the United States. But the math gets worse still. The on-balance sheet liabilities of the U.S. government now exceed $38 trillion, while the net present value of off-balance sheet obligations, not the nominal value, but the net present value of off-balance sheet obligations, Medicare, Medicaid, Social Security, military pensions, federal government pensions, that number exceeds $120 trillion. Taken together, the aggregate federal liabilities before any other liabilities in the system exceed $150 trillion. In a country where the private net worth of all citizens combined, you and me and all your listeners, is $161 trillion. There's not much money left over after government debt for us. To make that worse, the twin deficits, on-balance sheet and off-balance sheet, grow by $4 trillion a year. To put that in perspective, the gross income of the federal government, before we harass a taxpayer, before we buy a ballroom on the wall at the White House, before we buy a bomb, is $5 trillion. The deficit increases by $4 trillion a year, and our aggregate gross income is $5 trillion a year. The math doesn't math. So for those two lousy reasons, I'm a gold bull. I remember, Dunnigan, in the decade of the 70s, the U.S. dollar lost 75% of its purchasing power, a record I think it's going to match. And the consequence of that was that the gold price went up 28-fold.
The financial math worsens under political realities. Governments burdened with massive debt face constant pressure to keep interest rates low. Lower rates stimulate spending and ease debt servicing, but they punish savers by widening negative real returns. Meanwhile, total government obligations, both visible debt and long-term promises, have ballooned far beyond annual revenues. Deficits continue growing faster than income, an unsustainable trajectory. Historically, societies resolve this imbalance not through austerity, but through inflation. In such environments, tangible assets outperform because they cannot be printed, diluted, or legislated into existence.
I'm not suggesting to you that the gold price is going to go up 28-fold, but I am suggesting to you that the nominal price of gold, thank you for your use of that word, will mirror the deterioration of the purchasing power of the U.S. dollar. Specifically, that means that I think there's at least a strong possibility that the gold price in nominal terms over the next 10 years goes up threefold or fourfold. It wouldn't surprise me, given the incredible increase in the gold price that we've seen this year and the more incredible price in the silver that we've seen this year, that it takes a breath, that it takes a pause. That wouldn't surprise me at all. But I think over 10 years, the direction of the gold price is explained again by our old slogan about inevitable rather than imminent. I need to tell your listeners something else, Dunnigan, because too many of them will take away the fact that I think the nominal price of gold is going to go up threefold and stop listening right there. What I can guarantee you will happen, is that at some point in time in the next 10 years, the gold price will fall by 30 or 35%. That's the way bull markets work. And if you aren't psychologically and financially prepared for that 30% decline, what you're going to do is get shaken out of a gold bull market that's going to be absolutely one for the record. I remember in the aforementioned decade of the 1970s when the gold price went up 28-fold. In 1975, the gold price fell by half in 9 months, and the gold stocks fell further. There were people who were real gold bugs as a consequence of the $35 to $200 move that occurred prior to 1975. And those people forgot how to spell gold in the next 9 months. They got shaken out of that market, and they got shaken out of a market that then rose eightfold in 5.5 years. So I believe that this gold bull market that we're into is one for the record books. I also believe that people who aren't financially and psychologically durable are going to get shaken out of it. So forewarned is forearmed. I'm not going to get shaken out of it.
History offers a roadmap. During the 1970s, persistent inflation stripped the dollar of most of its purchasing power, while gold surged dramatically. That rise was not smooth. Sharp corrections occurred, shaking out investors who lacked conviction. Yet the long-term trend rewarded patience. Today's environment echoes that period: high debt, political constraints, and declining real returns. While future gains may not mirror past extremes, history suggests precious metals tend to reflect currency deterioration over time. Volatility is inevitable, but direction is shaped by structural forces, not short-term sentiment.
Well, let's look at history rather than forecasting. History teaches us that in a primary metals bull market, over the course of the market, the miners in aggregate outperform the metal about 2-to-1. So I think that's important to understand. By the way, they outperform, if that's the right phrase. They exacerbate the market moves in both directions. So they outpace the market on the upside. They outpace the market on the downside. Buyer beware. I have said on your show before that there are 3 uses for gold. One is as a savings or insurance product. That's physical gold. That's what Dunnigan Kaiser sells. I buy physical gold consistently, and I hope it doesn't go up in price because I own it really as insurance, social insurance, which I'm afraid I'm going to need, but I hope I don't. I'm an investor too, and as an investor, I buy very high quality gold shares. I'm buying companies that participate in the upside in gold because they make gold more efficiently than other companies do. And I'm a speculator in junior mining stocks. It's important for your constituency, Dunnigan, to allocate their portfolio relative to the reasons why they own gold, their time frames, and the risks that they're willing to endure. It's really important that people do that. When people consider the risks in the gold market, Dunnigan, I've been in the market 50 years now, and the biggest risk is really easy to find. It's to the left of your right ear and to the right of your left ear. And the way that you have prepared yourself in terms of doing the work and in terms of preparing yourself psychologically is going to be the biggest single determinant in never mind how much money you're going to make, but whether you're going to make any money at all.
Every major bull market includes painful declines. Precious metals are no exception. Significant pullbacks, sometimes 30% or more, are part of the process. Investors unprepared for volatility often exit at the worst possible moment. Understanding this psychological challenge is crucial. Successful participants distinguish between insurance, investment, and speculation. Physical metals serve as financial protection. High-quality mining equities offer leveraged exposure. Junior miners add risk and potential reward. Clear intent, time horizon, and risk tolerance matter more than forecasts. Discipline, not prediction, determines who benefits when long-term trends play out.
In fact, I'll expand on that. Anytime I buy anything, in investments, I write myself a 1-page memo as to why I did it and what could go wrong and what my targets are and what'll make me to sell. It's made me
What was I thinking?
made me a much better investor, you know? So let's think about what would cause me to sell my gold. That's a wonderful, wonderful way to frame the debate. I would have to see the reasons for the deterioration of the U.S. dollar purchasing power go away. I would have to see, as an example, some real prospect of a balanced federal budget. I would like to understand how the federal government, after they balance the current budget, proposes to service $150 trillion in liabilities. I think in particular, we need a political accord around entitlements. And that's going to be an ugly thing to do politically. You got a whole bunch of people who say about, as an example, Social Security, I paid in, I deserve it. But the arithmetic is too bad, so sad. The money isn't there. So I would need to see that political challenge. accomplished. And then I would need to see a positive real interest rate, which is to say an interest rate where my return on savings was more than the deterioration of the purchasing power of the US dollar. Historically, real interest rates for superb credits have been between 1.5% and 2% above the rate of deterioration of the purchasing power of the currency. If you agree with me that the deterioration of the purchasing power of the US dollar is proceeding along about 8%, that means that the US 10-year Treasury, rather than yielding 4.2, would have to yield some number between 9.5 and 10. Traditionally, the prime interest rate, currently about 6, sells at 150 or 200 basis point premium to the 10-year, which would suggest a prime interest rate in the 11.5 or 12% range. And traditionally, the 30-year fixed mortgage rate, by the way, traditionally with a 20% down payment, going back to when lenders were saying, has traded in a range similar to the prime rate. Now, can you imagine what a 12% first mortgage rate would do to the housing market? So I would either need to see greatly lower inflation or greatly higher interest rates or both. To recap, I'd need to see political consensus around a balanced federal budget. I'd need to see political consensus around solving the debt, servicing the debt, in particular, the debt around entitlements. And I'd need to see a positive real interest rate. We got there, by the way, in 1981. Paul Volcker came in, raised the prime rate to 19%, knocked the stuffing out of every leveraged speculator on the planet, including a young guy named Rick Rule. But we tempered inflationary expectations, and while we didn't balance the budget, and we didn't, in fact, reduce federal spending, we reduced the growth of federal spending enough that when the economy recovered, growth outpaced debt. And that virtuous circumstance gave us 40 pretty good years. So I need to see some resolution of these problems in the way that we saw a partial resolution in 1980. The difficulty is, of course, that our starting point, our federal debt, is much higher now as a percentage of GDP than it was then. So the challenge that's in front of us is greater. I wish I didn't have to say all these things. I wish, honestly, Donegan, I wish at age 72 I could come on your show and say, you know what? It's done. Fear's past. Sell your gold. Buy treasuries. Happy days are here again. But you asked me what would cause me to sell my gold, and I've told you that. And I think the probability of a resolution of those problems in the next 10 years is really low.
A true reversal would require profound change. Governments would need credible fiscal discipline, realistic solutions to long-term obligations, and sustained political consensus. Most importantly, savers would need positive real interest rates, returns meaningfully above inflation. History shows this is possible but painful, as seen in the early 1980s when aggressive rate hikes restored confidence at great economic cost. Today's starting point is far more leveraged, making such solutions harder. Until real returns reappear and debt trajectories reverse, the fundamental case for gold remains intact, not as a trade, but as financial self-defense.